Alright, for this video tutorial I want to go through a sample Form 1065 for 2022, and this pattern we're going to be looking at a rental real estate entity, right? So this is an LLC that's a partnership, so it has more than one owner, and the principal purpose of the entity is to hold real estate and rent that to tenants, okay? So as far as what I've got in front of us here, I've got slides, so 2 slides. First one covers all the elements that we're going to talk about. The second one is the fact pattern. And then in addition to that, we do have the financial statements for the LLC. So just prepared very simple rental real estate financial statements, right? So profit and loss on the left, balance sheet on the right. I do have a simple kind of reconciliation here of what's being reported on the 8825 and then what are the separately stated items. And then a capital roll forward. So this just shows the partners, their ownership percentage, the amount of income not the amount of income, but the amount of capital they put in, and then their allocation of the income or loss for the year. And then lastly, we have the tax return itself, right? So a 1065 for 2022. So we'll go through this, all the relevant pieces that you need to be mindful of, and hopefully it'll all come together at the end. So if I go back to the slide here, what I want to cover. So obviously this is a 1065 tutorial, so we have the return, we have the financial statements. Now as far as what's going to be on the return, we're going to complete pages 1 through 5, so those are kind of like the standard set that we always see with partnerships. The 8825 is where we report the income and expense, so the rental income and expense of the operation for each property. In our case we just have one, so it's going to be relatively simple. The 4562 is where we report the depreciation expense. That's bonus depreciation and the regular depreciation and amortization. Schedule B1 the disclosure of substantial owners, right? So if you own a certain percentage or more in a partnership, you have to list that person or that entity on Schedule B1. And then we'll cover Schedules K1. Right, so this is necessary for every single partner. And then K2 and K3, we're going to add those, cover those very quickly. This is a partnership that could maybe qualify for the domestic filing exception, but we're going to go ahead and complete the part on the foreign tax credit in K2 and K3, and I'll show you how that's done. Try to keep that as simple as possible as well. Now we'll also talk about FBAR or foreign bank account reporting. So this company opened a foreign bank account, so that's an issue for them. Separately stated items on the K1, so the interest income pieces, we'll talk about that, and when we get to the K2 and K3. Bonus depreciation, so we're going to show how that's being used following a cost segregation study. So very, very helpful tools to try to lower your rental real estate net income for the period, try to help save on taxes. Talk about basis issues for partners, so we will look at the basis worksheets and calculations, and then talk about some safe harbor elections, right? So we have the de minimis safe harbor election for property expenditures, and then a routine maintenance safe harbor election, which is very, very common and popular for landlords, right? Okay, so now let's go look at the fact pattern, and then we'll jump into the financial statements and then the return. So we have John Smith and Jane Doe. They're friends. They decide to partner up, and they want to buy a rental property in Miami. So each of them put in $200,000 in cash, and there's not going to be any distributions during 2022. So we'll see all that on the financial statements. The LLC financed the purchase of a single-family home in Miami, right, June 27, 2022. So they put up 30% in cash, right, and then they financed the remainder of the balance. And they did that using a 15-year note. Now the property was immediately rented out, right, pretty quickly, July 1st, 2022. And so what they've also done here is they had a cost segregation study done to reallocate the purchase price, right? So the all-in purchase price, $1.195 million. Following the cost segregation study, they've broken it out into these various components, right? So we have the home itself, the improvements, which are 15-year property, 5-year property, and then the land, right? Remember, land is not deductible. Now, what we'll see is the cost segregation that does this for us is very, very useful because we can generally claim bonus depreciation anytime you have property that has a useful life of 20 years or less, right? So that's these pieces right here. The home, for residential real estate, 27.5-year property, you can't bonus depreciate a home, but you can bonus depreciate improvements and other items that are part of that property. Now, the loan origination fees, these are amortized over the term of the loan. So we have a 15-year note, so it means we're going to amortize these costs straight line over a period of 15 years. And then lastly, the John and Jane are looking to buy an additional rental property, but they're looking to Belize, right? So they're going to go overseas to buy something. So in anticipation of that, they opened a foreign bank account with a Belize bank. And they're going to purchase the property in 2023, but for 2022, the only foreign exposure they have here is they own a foreign account, and there's going to be some non-U.S. interest income earned on that bank account. All right, so let's move over to the financial statements. We'll talk about these very quickly, and then we'll start looking at the return. So on the left-hand side here, we have the profit and loss. So our rental income for the period for those 6 months, and a variety of expenses, right? Cleaning fees, the interest expense, property taxes. We can see here the depreciation and amortization. So depreciation is, we're taking bonus depreciation for everything under 20 years, right? That's, again, the appeal with the cost segregation study. And then that also includes just the straight line amortization of straight line depreciation of the house, so the 27.5-year property. Loan origination fees, the amortization expense there for $279, so not much. And then lastly here we have, again, the interest income. So we have the U.S. and foreign accounts. So we have some non-U.S. interest income and some U.S. interest income. Those are separately stated items. And then what we'll see on the K2 and K3 is where we separately even break these out even further, right? And you'll see what I mean when we get to looking at those. All right, on the balance sheet side here, again, nothing too tricky, right? So we have two checking accounts, savings accounts, so again, U.S. and foreign. The Belize account here, this is, again, why we're filing an FBAR, right? So you're going to need to disclose on the return that you have a foreign bank account and then file an FBAR separately. All right, on the fixed asset section, we separately state all the items, right? So we have the house, the 27.5-year property, 15-year property, 5-year property, right? All that looks good. Loan origination fees, and then the related depreciation and amortization. Now, on the bottom here, we've got the liabilities, so the security deposit provided by the tenant, a little credit card debt at the end of the year. And then lastly, the big note, right? The mortgage, the 15-year note on the property, that's the outstanding balance at the end of 2022. And then the equity section, the contributions for Jane Doe and John Smith. All right, so now let's have a look at the return itself and start entering some of these components. So best place to start is always page 1 at the top, right? So name of the partnership, the principal business activity, and code number. You can look those up in the instructions. The tax ID number for the company, and the date the business started. So this was our entity formation date. And so that's kind of when they not only formed the entity, but when they started looking for property, right? Now, note that date is going to be different than the date we use for depreciation purposes, right? Because the date the property was acquired and placed into service is much later. So we got June 15th, 2022. We've indicated up here the short period year for the return, right? So it's not a full calendar year, 2022. So we've had to enter Jan 15 through December 31st, 2022. We do have an initial year return here, and we are going to be using the cash basis. Now, page 1, and this often throws a lot of people here, is you notice there's no dollar entries here, right? There's no numbers here. This is fine, right? Because this activity is a rental activity. It is not a trade or business, right? So on page 1, we only include trade or business income and expenses. When we have activities that qualify as rental activities, those go in other parts of the return. And so that's what we're going to see later on. Next place to go is Schedule B, right? So this is a lot of yes or no questions. It helps us kind of determine what additional filings we might need to include. So we have a domestic LLC here, and in 2B, we have indicated that yes, we have an individual that owns 50% or more of the profit, loss, or capital, and so that's why we're including a B1, because John and Jane each own 50%. Now the rest of the items here are all just no's. So again, like the yes or no questions, just read each question carefully, answer yes or no. Number 4 often confuses people, especially kind of new preparers, right? So question 4, you can get out of including or filling out schedules L, M1, and M2, right, if you qualify. But as a best practice, I kind of ignore this, right? I answer the question appropriately, but I don't leave schedules L, M1, and M2 blank, even if I can do that. So even for very small partnerships that would otherwise be exempt from doing these schedules, I always complete them anyway. I think it just makes for a more complete return. But in our case, we had to do them. So yes or no. Okay, again, question 8 here. So notice question 8 is asking about foreign accounts, right? So we did have an interest in a foreign bank account, so I've indicated yes. And then the 2 country code BH is short for Belize. And so the FBAR isn't included in the 1065. It's a separate filing. And I won't go over that on this tutorial because I'm just trying to do the 1065 itself. But if you do have an interest in a foreign account, you might have to file an FBAR. And so that's why we have indicated yes. All right, so as we move on down here, again, a number of more no kind of answers, right, to some of these questions. So fortunately, they don't apply to us. We did check yes and filed 1099s because we did have to issue some 1099s for contract labor. So that's fine. So we've done our 1099s. And then all the rest of these are also no, right? So none of these apply given our circumstances. And we have designated John here as the partnership representative. All right, so I think next good place to start is the balance sheet. So we'll look at the balance sheet and then we'll start entering some of the income and expense items. So balance sheet per books, right? So this should reconcile with the balance sheet that you have per your books, right? So if we look at our financial statements, again, remember we have cash up here, we have the fixed assets, non-depreciable land, some intangible assets that are being amortized, and then the liabilities, right? So we're just transferring these values to the Schedule L. So we've got the cash up there. There's our intangible, the loan origination costs, $945,000. That's the building itself plus the improvements, and then the other 5-year property as well. $250,000 there. Report on land 11 is the land, right? And then in the liability section here, we got the tenant security deposit, the credit card liabilities, and then the mortgages, notes, and bonds payable for a year or more. That's the mortgage on the property, right? So $816,061 is the outstanding amount of debt. And then the net capital accounts at the end of the year is going to be $256,1116. Now, in arriving at the depreciation, right? So that is found on 4562. So if we have a quick look at the 4562, and then I'll come back to M1 and M2s. So 4562 is where we disclose all the depreciable assets, right, and the depreciation expense we're taking. So in part 2, this is where we have the bonus depreciation for the qualified property, right? So the $130,400, that is the bonus depreciation for the 15-year and the 5-year property, right? So $130,000, that's these 2 components here. So $130,400, that's what's being depreciated here as bonus depreciation. In part 3, we report the just regular depreciation, right? So items that we are not claiming the bonus depreciation on, or Section 179 expense or something like that, right? So we have, you can see here, July 2022 is when we place the property into service for rent. That is the valuation or the allocation given to the residential rental property itself. Remember, that was per the cost segregation study. And so the recovery period, again, is 27 and a half years using the mid-month convention and a straight line method. The amount of depreciation we have for the period is $13,579. So when we add these 2 together, that's how we get our $143,979. So that is the depreciation expense for the year. Right. Now, the second page of the 4562 is where we have our amortization, and that's at the bottom here. So part 6, we have our loan origination costs, amortization, again, starting date, place in service, the 8360, AMT for amortization over a 15-year period because the note is for 15 years, right? If you had a 25-year note, then you would amortize it over 25 years, right? And that's the amortization expense we have for the period. All right, if I go back to the M1 and M2, just cover these very quickly here. So Schedule M1, reconciliation of income or loss per books with net income or loss per return. So net income or loss per books is the 143,884, right? That reconciles with our profit and loss here for books, right? 143,884. And then you would have any book tax adjustments in arriving at your net income or loss per return, if there were any. In our case, we have pretty straightforward return, right? We don't have any book tax adjustments per our return. Now, what you might commonly see is if you have a rental property kind of entity and you're not using the tax depreciation that matches books to your tax return. So in other words, their book financial statements are just using the depreciation expense they would have for tax purposes to try to make things easier. But if you had to prepare, let's say, U.S. GAAP financial statements, you wouldn't be using this number, right? Under U.S. GAAP, these items are going to be depreciated under much different rules, and so the amounts will vary. And if you have varying amounts for that reason, you might see some adjustments here for where we reconcile our income or loss per books with return because we have different depreciation amounts. Yet in this case, trying to keep it pretty simple so we have no variance. M2 is a partner capital account roll forward. Right, so there's the $400,000 that was put into the business by John and Jane Doe. So remember, there's $200,000 each. There's the net income or loss allocated to them, and then their ending capital account balance. Now, if we look at the 8825 next, this is where most of the activity is happening, right? So this is where we report rental real estate income and expense. So column A, or I should say row A, corresponds to column A for the property here. So we have the physical address of the property, the type of property itself, right? So is it a commercial property? Is it a single-family home, multifamily unit? Is it a self-rental? What applies in this case? So in our case, we do have a single-family home, and the number of fair rental days, so the days it was rented during the year at fair value, is 183. No personal use, right? So John and Jane are not using this at all for personal reasons. And so then on column A, we just enter the income and expense, consistent with what we have on our financial statements, and then the depreciation flows through and the amortization flows through from the 4562. So we've got our rents, advertising costs, there's our interest expense, $20,679. And so when we get to the bottom here, we've got our net income or loss from the property directly here is $144,075. Now, when we look at our profit and loss, remember we have some separately stated items here, right? So the interest income isn't going to be aggregated or reported here, right, in column A. It's a separately stated item on the K1. So when we talk about separately stated items on the K1, what we mean is, if you have an item of income or expense that is directly related to one of these categories, then they generally have to be separately stated. So you can see here on line 2, the minus 144,075, that's flowing through from the 8825. The interest income, the U.S. and foreign, is reported here, line 5, 191. Right, so if we have a look at the financial statements, if you add those up, right, $121.70, $191, that's what's being separately stated here on line 5. All right, so now let's have a look at the K1s for the partners. So if I scroll down here, talked about the 4562. There's the depreciation schedule. So you can see how we've broken them out basically by category, right? So we have the house itself, the land piece, which is the cost basis at $250,000, but its depreciable basis is effectively zero, right? Because we're not depreciating any of it. The land improvements and the appliances, carpets, all that stuff, that's 5-year property. All of that is being subject to bonus depreciation. So that's why we see here we have current year amounts for bonus depreciation equal to whatever the cost was. We can see the piece, the current year deduction for the house itself, $13,579, and then the amortization expense for the loan origination cost, $279. All right, so now moving on to K2. So K2 and K1. So K2, again, is the distributed share of international items. So in section C, you can see here lines 1 through 12 a lot of no check boxes for items that just don't apply to us, right? And so the only one we are doing is Part 2. So I've indicated yes there, and here we have Part 2, foreign tax credit limitation items. So this is where we kind of separate out items of gross income and expenses and designate them by source, right? So you can see, for example, the gross rental real estate income from in the U.S. source in column A, $42,000. And then down here on line 6, this is where we separate the interest. So interest income U.S. of A, U.S. source, $70. And then interest income coming from Belize, which is foreign source passive category income, 121. And so this information can be useful for the partners just so they can see the sourcing. Because if we look at the K1, let me look at the K1 really quickly for us here. You remember or familiar with, all of the interests or dividends or whatever it might be, they all just get aggregated and reported as one line item, right? So all of the interest being allocated to John here, $96, that's the total amount of interest. But by just looking at this, John cannot see what portion of this is U.S. versus what's foreign. So that's why the K3 is very important or very helpful for John, because you can see, okay, I had $96 in interest income allocated to me. If he goes down to his K3 here, $96 in interest income allocated to me, right? That's what John's thinking. And you can see here, oh, okay, so U.S. source, U.S. of A, $35, and then $61 for the foreign piece. So the 35 and 61 you see here, add those up, you get 96, right? So that's the total amount of interest that John's got flowing through on his K1, right? So you can see how all these items slowly kind of start to piece together and complement one another. All right, so if I go back to the K2 here really quickly, I want to finish running through this. So the gross rental income there, I've separately stated the interest and then got to complete the rest of it for Part 2. So we have the totals are down here, right? That's good for the partnership. And then the deductions are in Section 2. So Part 2, Section 2. We have the depreciation, depletion, and amortization. The totals reported there. Again, U.S. source. All the other expenses that are not attributed to depreciation or amortization. And then we have the interest separately stated as well. Again, all of this is U.S. source. So nothing too, I guess, tricky here. It will be a little more complicated if they get that Belize rental property up and running. But again, the point is to try to make it clear and separately state where the interest is coming from, because that might be relevant to the taxpayer, right? So they need to know this kind of stuff when they're preparing their 1040. All right, so now let's go to the K1 and talk about some of the elements on here. So the K1, this is the K1 for John. Remember, they're each 50% partners, so everything here should just be allocated 50%. It's just split down the middle. So we've got John's information here, his tax ID number, information on the partnership. And then in the section K here and item L is the partner's capital account reconciliation. So that's the capital John put in during the year, his allocation and net income or loss, and then his ending capital account. Now, remember, when we have partnerships allocate their liabilities to the partners, and it's used to increase their basis. So the mortgage debt on the property itself constitutes qualified non-recourse financing, and then all the other debts are just non-recourse debts, right? So the security deposit, the credit card liabilities, we're just considering those non-recourse debt. But what's unique about mortgages on properties is they generally treated as qualified non-recourse financing because the loan is secured by the real estate. All right, so if I scroll up here, so we talked about the interest. There's John's allocation of the net real estate loss for the period. Line 20 just has information on the investment income, so that's just the interest. And then this is his allocation of the interest expense. So $10,340 in interest was allocated, and that's buried in this line 2 amount. All right, so move on to the supplemental information. All right, so again, this software generates for us quite nicely just some additional information or notes on what the items are. So again, there's his allocation of the loss, the interest income. So the total current year net income or loss is $71,942. That's what John sees here in his item L reconciliation. All right. Okay, so now let's talk about the basis worksheets because these are really important for partners. So a partner's basis in a partnership is a combination of their capital account, so effectively what you see in that item LREC, plus their allocation of liabilities, right? And so when we look at a partner's basis worksheets, we're factoring in an increase in their liabilities, so their allocation of debt, plus the capital contributions and allocations of net income or loss. So when we start with the basis, so up here, right, line 1 is his basis from the preceding year, so it's 0, right, because this was a company formed in 2022. So $200,000 increase to his basis, allocation of $96 of interest is an increase, and then the line 4 here, increase in partner's share of liabilities. So the total amount of increases to his basis, $615,000 $278, right, because that's a combination again of his capital account plus his allocation of the debts. Then reductions to basis are the losses, right? So rental real estate loss, that was his allocation, $72,038. And so we look at his ending basis down here. His adjusted basis is just going to be $543,240. Now, kind of a quick check just to see where that number is ultimately coming from. The $543,240 is if you add up his share of the liabilities plus his capital account. So if I open up a calculator here, if we add up 7151 plus 408031 plus the 128058, there's his $543,240 basis. Okay, so that's reconciling with what we have on his worksheet here. And then the next piece that John will have is just his Schedule K3, right? So it's his allocation of what we see on the K2 items, right? And that's it. So I won't go through Jane's, right, because it's just a duplicate of what John has. But yeah, so that covers it for this video. I hope that was helpful. If you have any questions, feel free to leave me a comment below. And I look forward to seeing you again on the next series. Thanks.